All right, and we are live. What's up, everyone? Welcome to another Ask Me Anything happy hour with the Money Multiplier BYOB Money Mentor team. We're here every single Wednesday, 4:30 Eastern, to answer all of your questions about infinite banking, becoming your own banker, whole life insurance, IULs, real estate, annuities, really any kind of guaranteed financial strategies and alternative investing, self-directed retirement accounts, and everything in that world. So happy to answer all your questions. Get them over in the chat box. We'll be answering them as they come in. I see a couple coming in right now that we can start with. So we'll do a quick around the horn, do some introductions, and we'll get this baby started. Be back in 14 seconds. All right, welcome back. Welcome to Ask Me Anything Happy Hour. My name's Stephen Nagy. I'll be helping today along with the other BYOB Money Mentors, answering all your questions. So we'll do a quick introduction. I'm down here in Southeast Florida, in Hobe Sound, over on the East Coast, Atlantic side, but fully licensed in all 50 states to help clients with life insurance. I've also been a licensed real estate agent for a very long time, although I'm not active in that industry, and work every day within Private Money Club, helping our clients with private lending, borrowing, and evaluating real estate deals. So I've been doing this now for almost 20 years. When I left my career as a personal financial advisor right out of college, and been in the space ever since. So with that said, I'll pass it over to Brian Fouts.
Hey everybody, Brian Fouts up in North Idaho. Yeah, it's interesting. I've been teaching infinite banking or talking about infinite banking or doing webinars on it for about a little over 10 years now. It's crazy. It's been that long. Learned a lot in that time frame. Also doing annuities now, which is very kind of cool to see how those are working for helping people out right now. A lot of stuff going on, but yeah, it's pretty good opportunities right now. So I'll get those questions in the comment box and I'll pass it down to Mr. Linus.
Thanks, Brian. Hey everyone, Linus Nolt here from Hopkinsville, Kentucky. I first learned about this concept in 2020, so 6 years ago. First started my first policy and implementing the infinite banking concept in 21, so it's been over 5 years now. And then it was late 2022, I joined this team, and I've since become a top expert on getting approved for a policy design, things like that, and the infinite banking concept in general. So that's where I'm at now. Happy to be here and help answer any questions. I've been busy helping a lot of people and want to help as many here as I can as well. I want to shout out to Just a Variation, the rap guy from Nevada, I think, money rap guy, something like that. Good to have you again. Go ahead, Tess.
Hey, I'm Tess Ulick. I am in Michigan, and we have clean air finally. We had all the wildfire smoke last week, and they were saying you should have a index of under 100, and we were over 500 for about 4 days. So it's nice to have our air back. Insurance has been my life, but not from this side. I actually came on board in 2020 to prove Chris Noggle a scam, because as an insurance accounting professional, I thought he couldn't know something I didn't. When I found out he knew something I didn't, I joined the team. Great to be here with you all, and looking forward to helping as many as we can.
Yeah. Cool. Any questions we got going on yet? If not, I got a couple we can go over here as well. Actually, look at this question here. This is a good one that came in. It says, is the exposure and risk the same in the annuity space as with the life insurance policy space? So exposure and risk. And they're asking, is annuities the same exposure and risk as a life insurance?
So are they asking as far as their own exposure and risk, or as far as the life insurance company goes, trying to give them the guarantees?
We don't know. They weren't specific on that question.
I'll take it from the life insurance company side. It's going to be basically the same. Both of them are going to be with a life insurance company. Now, not all life insurance companies are created equal, so you want to look into that a little bit. You're banking on their guarantees. The good life insurance companies that we work with have been around for hundreds of years, have been profitable. Sorry, I said well over 100 years. correction there, and have been profitable for well over 100 years. And so that certainly means something through every, war, depression, and recession and everything in between. So that certainly means something. You want to be looking at that. So all that to say that's what it would look like on the life insurance company side for yourself. I'll let somebody else speak to that.
I can speak to the annuity side of it versus, just from a client perspective, annuities versus life insurance. It's not really about risk and exposure to me. It's about what's accomplishing your goals. Because when you look at the life insurance space, what's the risk and the exposure there? I mean, in my opinion, it's virtually nothing because as Linda said, the life insurance companies are extremely stable. They've always paid dividends, been profitable, all that kind of stuff. So the risk is actually with the policy holder. Okay? With an annuity, it's kind of the same thing because it's with an insurance company. Now, when it comes to an annuity, there's lots of companies that can do those, lots and lots and lots. And when we look at quotes for annuities, we're looking at sometimes 15 quotes. But what we do is we categorize the companies by A+ rated companies all the way down to like B companies. We cut out all of the B companies. We just don't even talk to them. We don't even bother working with them. We want to work with what are A+ companies. And those ones are the top rated companies. They've been around for a long time, et cetera, et cetera. They're the most stable company. So we tend to go with high rated companies, but annuity, they're guaranteed. So if you're with a company that's been around paying dividends and profit for over 100 years, there's not really a lot of exposure and risk because you're not tied to the markets. So it's not like an IUL, which is tied to the markets, where you can have risk and ups and downs and all that kind of stuff. So I would say they're pretty much in the same bucket as far as exposure and risk goes, in my opinion, as long as you're with a good company.
I think the one exception might be like the fixed indexed annuities, because those do have a part of them that are connected because they have a zero floor, but you can earn more.
You're referring to variable fixed annuities.
Well, there's also the fixed index.
A fixed index annuity has a guaranteed rate of return. It can't go down. So let's say it's 8%. So an FIA, fixed index annuity, has the floor of whatever the rate is that it's set at that point in time. It can go up though. So you can actually get a benefit of the markets going up, but the floor is not zero. It's whatever the guaranteed rate is. So it could be 6.2%. Like the one I did today was 6.2%.
It is flexible. It's not guaranteed at a set rate forever. Right.
All right. Anthony says, do whole life policies ever have indexed appreciation risk, or is that something with IULs? I know that whole life is designed to be more stable and steady, so it would make sense if they do not.
No, they are not. That's the big difference between whole life and IUL, is that the whole life is not indexed to the market. It is providing you, the company is providing you the guaranteed rate of return. So the risk is on them to go out and make the money, to hold good to the guarantees, the guaranteed death benefit as well, that they are guaranteeing you. I do know of like at least one company that allows you to take the dividend each year and actually index it to an index, but not the policy necessarily. It's just the dividend, because you have a number of different options that you can do with the dividend. You can have it paid out in cash to you each year. You can have it applied to the policy in the form of PUA, which is what we're always going to set up, because that's where the biggest compounding effect comes from in a safe manner. But there are other options. It can be applied towards the premium on the policy. It can be applied towards policy loan repayments on the policy, and a couple other options. But one I'll mention, like I just said, it can be put into an index where now you're taking on risk. You can lose it entirely. You can gain some on it, but nothing's guaranteed there. So you can index it throughout the year rather than having it applied to the policy directly.
Yeah, and he's also asking which companies allows the dividend index. They pretty much all have that option.
No,
but they have to have an index division though. That's the big catch.
Mm-hmm.
Right.
Yeah, the only ones I'm familiar with that do have that option is going to be One America and Guardian.
I thought Lafayette had it too.
No, they don't.
Well, they have it with Western and Southern does, not Lafayette.
Oh, they might, yeah, but Lafayette does not.
Then, I think Mass does. I thought Mass does.
I don't think so. I've looked and I haven't seen it, but maybe they do. I would think they do. They're so big and stuff, but
yeah,
I haven't seen it.
it's just not very common, and it doesn't make a lot of sense to do it when you're trying to have more certainty around your money.
Mm-hmm.
So you don't see it a lot, but we do get a lot of questions on it because the companies will send you a letter in the mail at the anniversary talking about it. And we always just tell people, slide it off your desk, right into the trash can, because you're not going to want to select that. I've never known anybody that had that option selected, by the way. I've never met anybody that did it.
Yeah, it can even look attractive because that notice will tell you, okay, here's where the market started for the year, here's where it ended for the year, but here's how much of your dividend that was indexed in it. It'll have a big fat zero there. And it's like, oh, wait a minute, did I lose out on something? And then you go to the next section and you'll see, okay, your dividend of this much was used to buy this much of paid up additional death benefit. And it's like, okay, well, that looks good. We really made some gains there. And of course, that all converts to cash value, the dividend. So it's cool.
Yeah.
Especially when you look at a kid's policy and you might see that the dividend was, say, $50, but it bought 500 or even more dollars of PUA on the spot. And now that's in place and guaranteed for the rest of that person's life. And it has that guaranteed growth on the cash value thereof too. So it's amazing.
Or to be young again.
Yeah. Another question came in here today, and it's a pretty simple question, but it's one that there's lots of different answers depending on who you ask. And it says, which company has the best whole life policy?
Ooh, it depends on what you need.
Well, that's a huge, it depends.
Yeah.
Depends on who's setting it up. First off, it depends on the agent or broker that is setting up the policy. Like that's the first and foremost, because it's not the insurance company per se that's the best. It's, in my opinion, it's the agent, because you can have a good mechanic or a bad mechanic, same car, but one agent or one mechanic, it won't run afterwards very well. One will run pretty good, but I'll let you guys take that question. It's a pretty good one.
Yeah, it's going to depend a whole lot on what you're doing with it, like Tess alluded to as well. Because the question only referred to whole life. It didn't really mention infinite banking, or am I remembering wrong?
I think whole life is
because here's what I'm thinking. If somebody is just looking at whole life for the death benefit, for a protection piece, and they're not especially designing for whole life, it changes which company and which product is going to fit best for what you need versus one that you're trying to get a high early cash value to go out right away and knock out debt, or to invest from, buy the next car with, things like that, practicing infinite banking. So it certainly depends what the use case is. And it also makes a difference between where somebody has a high early need for that cash value to go do something right away, like I mentioned, or if it's a little bit more of a longer term, hey, we're going to build up over 5 years before we're ever going to use it. It's just more of an accumulation in a opportunity fund or savings vehicle, really. So that's going to make a big difference on what company and what product gets chosen to do the job too, because they all kind of have different strengths and weaknesses in what areas they can be designed better or perform better. So many different pieces.
And I think even kind of back to what Brian said, some agents are really appointed by one company, where most of us are appointed by 3, 4, 5, some of us 6. But if they're captive with one insurance company, they're only going to have that products for that one company.
Yeah. That's one thing to be very careful of, is and I've had this happen so many times where they go to a financial advisor who can do insurance, but they're only with one company, and it's not the best for, infinite banking. So it's that's why we do this, because age, gender, your goals, financials, all these stuff can dictate what company we go with. And there's other companies that do infinite banking that we don't work with, to be honest, but there's reasons why. Like their support is not the best. They don't want to, they support infinite banking, but they're not willing to give us the resources or listen to us to make it better with that company. Lots of reasons, but we have a good relationship with the companies we work with, and that's why we work with them. So it's all relationship based in this, in my opinion. Let's see here. Any other question we got?
Yeah, I even see it be an issue sometimes with agents or agencies that do specialize in infinite banking, where they've picked out a favorite company and they simply take everybody to that company with no other option. Maybe the agent just hasn't really learned about some of the the better options for certain scenarios at other companies, or they just refuse to. I don't know what that is there, but I see quite a bit of that in a lot of areas, and even maybe not doing some of the different types of designs that we know how, where it seems like they kind of stick to one certain design to fit everybody, what we call as a cookie cutter application. There's plenty of those, but there's plenty of us good ones out there too. But we are here for you.
And a lot of reasons why you'll see a group like that going with one company is because every company has different ways of writing policies, and it can get kind of complicated. And if you're not doing this every single day, like, you don't want to have 3 different types of policies to write, because you might not remember how to do them the best way. So they stick with one thing, what they know. It is kind of cookie cutter, but they don't have to relearn every time they go and do it. But we do this every single day. I mean, we're writing illustrations sometimes 3 to 5 times a day with different companies. So that's a big difference right there. Now, this is an interesting one. So this is a good question. It says, my husband and I took out an IUL on each of our girls. This was maybe 3 days before they learned about all of this stuff that we talk about. So it's maybe a week or so ago. We cannot change them as of right now, but what might that process be when we're able to switch them? And then another question was, isn't there a cancellation period?
Yeah.
Is there a look back period?
It's called a free look. Yeah, your free look period.
Yeah. That free look period would be no less than 10 days. Their agent is probably just telling them, oh, you can't undo anything. But if it's only been a week, by law, there's a free look period of at least 10 days. By law, in some states, it's up to 30 days. So, I mean, I would certainly be wanting to speak with those people ASAP to be like, hey, you have a legal right to cancel and get every dollar of premium back. Just simply undo the transaction for sure within 10 days from the effective date that you signed, maybe even longer. Yeah.
Some additional information here. It's been more than 3 days. Okay. Yeah. Plus it is through my parents. So that is a bit touchy. So what these are most likely are grandparent policies, which are, low death benefit, low premium. IULs, probably not focused on cash value at all, just a straight IUL. So on these kind of scenarios, if it's through like the grandparents or have done the policies, they're probably so small it doesn't make sense to cancel them to go to infinite banking. If you want to do infinite banking on your own with your kids, just go do second policies. Mm-hmm. Because those are grandparent policies. Let the grandparents fund them and feel good about those policies. That's it right there. But if you're wanting to do infinite banking on your kids, then definitely schedule a call with us, because I'd want to talk to you about your coverage first. What are you currently doing? Right? Because that's where the insurance company is going to look to you first and saying, why would you want to do it on your kids versus you first, even if they're small policies? This is a very simple question. So, Mr. Spudnik, how does someone get started with infinite banking?
Education.
Yep. Step 1 is educate yourself, educate yourself, educate yourself. That's why you're here. We'll put a link here in the chat box in a moment where you can go and schedule a call with one of us. There's going to be a video that you're going to want to watch. It's about 60 to 90 minutes that really walks through this infinite banking concept. You're going to want to watch that first. And then what you're going to want to identify kind of before you get on the call with us also is, what are you looking to accomplish with infinite banking? What are we solving with it? So when you look at this, what are you excited about with infinite banking? What gets you like, oh my gosh, I want to do this for this reason. And then we can work with you on making sure that we can, do the best policy for that and go through it, make sure it makes sense. But we'll put the call link here in just a moment, Mr. Spudnik, and you can go from there and grab a time with us.
And welcome to the Infinite Banking family. Yeah.
And also we'll put a link here Stephen will, because we do a lot of live events per week. We have about 6 live events, basically 1, 2, 3, 4 main ones. Wednesday is our big day. We have 3 events today. So we have WTF in the mornings, which is kind of us going kind of hot and heavy into politics, the markets, the news, etc. That's why it's called WTF, What Happened. We have the Wealth Wednesday webinar, which I definitely recommend attending that one. That's a different topic every week, sometimes infinite banking, sometimes annuity, sometimes we have guest speakers on there. But that's really going to help you on the mindset side of things. And then the third one is this event right here, Ask Me Anything, which we do every single week. And you're going to see a lot of questions come through from other people on infinite banking. So hearing other people ask questions to me is one of the best ways to learn, because they're going to have questions that you might not have thought of. And that's a great way to learn, is being here. So
I don't know if you guys know this, but I've been going to the onboarding call that's on Tuesday nights.
Mm-hmm.
And this is the one program that they highly recommend every week, AMA.
Yeah, I've gone on that thing many times before too, yeah. But yeah, so there you go. You bought the book, Infinite Banking, Becoming Your Own Banking by R. Nelson Nash. That's a great place to start. That's a good book. It's interesting to see when you read that book and then you start looking at current policies, how they've changed over the decades. But that's a great foundational book on the technical side of infinite banking. So yeah, definitely recommend that book.
Today's Wealth Wednesday might be a nice one to catch too, because Chris kind of identified 4 different types of Chris and Craig did 4 different types of policies, and it's very interesting to watch.
Yeah,
some evolution.
Let's see, we got another question.
Yeah, and Spodnik there, with as far as the book you bought, I don't know which one you bought. I would encourage to get the. Oh, is this mirrored? This is the original book. Okay. All right. It's mirrored for me for some reason. So this is Becoming Your Own Banker by R. Nelson Nash. You can get it on Amazon for like $21. Highly recommend getting that one if that's not the one you've already gotten. Maybe you got the one that Chris and Brent wrote, and that's also a great read. That's where I started as well.
Yeah. The Millionaire, Mapping Out the Millionaire Mystery. That's the one I started with too. That's Chris and Brent's book.
Yep. And I just put that link in the chat box. So go ahead and grab a time right there if you want with one of us, and go there. Okay, this is an interesting one. If you mean anything, I have some problem in my diet code. Can you help me fix it? That's a gaming platform, if I remember correctly. Video gaming platform online. So
maybe I was thinking it's a misspelling, because I think it should say Discord, and the A and the S are right beside each other on the. Yeah,
like Discord, I know what that is, but I'm not sure. I'm not sure what you're referring to there. So Mohammed Gamerest, if you want to clarify what you're asking for, we can help you maybe potentially.
It could be gaming too, though, because his name has game in the end of it.
Yeah, I know, that's what I thought. Yeah.
I think that's Discord. There's nothing.
Yeah, I don't know. Is HELOC Joe still alive? Many people are demanding proof of life. Yes, he's still alive. Joe has decided to take a break and kind of go do his own thing and focus on family for a while. And we'll see if he comes back. But right now he's just kind of doing his own thing temporarily. So
his wife just sent me a hello the other day. So yep.
There you go.
Good things.
That's the one. Not sure what you mean by that, but yeah. Oh, the book. Yes. Yeah. That's
that one. The great choice of first book. Excellent choice.
Yeah. Mm-hmm. And the other one I like is just from a financial knowledge perspective and business mindset perspective. I really like Robert Kiyosaki's book, Second Chance, which does mention infinite banking in it, by the way. It does talk about it. And then Tony Robbins' book, Money Master the Game, which has been around for a while. That's another really good financial, just foundational mindset book. And it talks about infinite banking in there. Does not call it infinite banking, though. Both books don't even say that term. But when I first read them, I was like, what is this they're talking about? I didn't know, because I read those books over 10 years ago. I had no clue what they're talking about. Then when I got into infinite banking, I'm like, oh my gosh, I got to go back and read that book now. And then it was like, oh my gosh, you got to be kidding me. This is what they're talking about. And so it's pretty cool. Yeah.
My favorite Kiyosaki book is Cash Flow Quadrant, but I can't remember if it talks about IBC in it.
No, that one I'm pretty certain it does not.
I don't remember talking about, but that's one of my favorites.
Callie47 says, I can't wait to get started. Left a message today, waiting for a call back. So Callie47, just by chance, is your first name Tracy?
She might have been the second call coming in. Yeah, because we had calls coming in overlapping earlier today.
Yeah. If it is, you'll be getting a call for sure. Yep. Okay. Any other questions? Get them in the chat box.
Yeah, Anthony, we've been helping Joe's clients quite a bit now, and so feel free to reach out to any one of us to help out.
Yep.
Big happy family.
Let's see here. Look at some of these questions in here that from earlier today. It's pretty funny. So this was kind of a weird one. I wasn't quite sure what they were referring to in this question. And it said, this is a prior webinar here today. It said, doesn't the cash balance plan need to pass non-discrimination testing?
Sorry, can you say that again?
Yeah. Doesn't the cash balance plan need to pass non-discrimination testing?
That almost makes me think
Right.
like 401ks and safe harbor.
There's probably three different things that I feel like it might be referring to, because there is an actual thing called a cash balance plan, and it's got to do with a specially designed or a special plan inside of a retirement account. I don't think that's what she was referring to. If she's talking about discrimination, as far as a cash balance plan, she might be talking about what is it called? Deferred comp plan for an executive in a company. Because that does come up, is do I have to get this for all the executives or all the employees, or can I actually discriminate on which ones I want to get this type of policy for deferred compensation plan? And that's true. Yeah. When it's a deferred comp plan, yes, it works more like a one-off bonus where you're allowed to discriminate on which executive or which key employee that you're compensating that way.
Yeah, life insurance can be it's not discriminatory, but people seem to think that it is that way because they can say no.
Yeah.
But yeah, it's not. I don't call it discriminatory. It's just it's guidelines. Insurance companies, to operate as a business successfully, they have to have guidelines, because if you're not a fit, here's an example. You have two people that are 50 years old, both male, same job, same state, same date of birth. One smokes, one does not. Okay. If they have to give each one the same plan, they're going to lose money most likely with the person that smokes, because their health is going to be impacted. They might not live as long. And so that's going to affect the insurance company. So they have guidelines. And so people say, oh, that's being discriminatory. Not really.
Insurance companies do the same, very similar testing to new employees that they do for underwriting a policy.
Yeah. It's like, I mean, when you go on a roller coaster and you're not allowed to get on it, is that discriminatory?
Yeah.
I mean, it's actually safety is why. Safety reasons. Yeah. So if the insurance company is just maintaining the integrity of the insurance company by having guidelines that you have to align with. That's just how I explain it. Let's see. Here we go. It's here. So Kathy's asking, is there a BYOB blueprint weekend scheduled? Like the next money tank? No, we don't have one scheduled right now. Our next event, our virtual event. If we do one, you'll hear about it here and on all of our presentations. We'll definitely be talking about it. You'll get emails on it too, but nothing's on the books right now. But I know we plan those typically every 3 to 4 months. It seems like. So we'll see.
Maybe
as far as the next money tank, there's not going to be another one this year. Last I heard, there was going to be maybe like an intimate, a small group event, more of a hands-on event at Chris's house, I think, this fall, and that's a little bit more one-on-one, maybe by invitation only. So email Shauna on that to see if there's even any room left on that one if you're interested.
Yep.
Steven's back.
Yeah.
He's
kind of
muted. Oh, there he's gone again.
Can you put in the links to the events, the event link, so people can grab that when you have a chance? Sputnik is asking, are the policies prepared by the state you reside in?
No, they're prepared by us, the experts on the concept.
They are regulated at the state level, but they're not prepared by the state.
They're based upon the state that you reside in, but they don't have to be prepared in the state, if that's what you mean. But whatever state you reside in is the state that your policy will be set up in. But the state that you reside in throughout your life is the laws that dictate how your policy is handled legally. Like, that's a question I've been asking, and it's kind of hard to get a straight answer. It says, if I get a policy in California and move to Florida, what state laws apply?
California still.
Yeah.
Unfortunately.
So it's mainly going to be the state that you get the policy set up in. But once again, though, in my research, I have heard conflicting things, but I have never been able to verify it.
Well,
it's state specific.
Mm-hmm.
Yeah,
it's a contract, and you know how when you do a contract, there's always a piece in there where it says this contract is governed by the laws in such and such state, and that's kind of how that comes together too. And also another piece of the answer is that we have to be licensed in whatever state that you're living in, that the policy is being delivered in. So yeah, that's why we are all licensed in all states.
Yeah. But it depends on the legalities of the state as well. I mean, I've heard some people talk about where they had some issues legally, and the state they resided in was a state that the laws were being applied to, but the policy from somewhere else. But once again, it depends on what the legal issue was. I don't remember what it was, but there's a lot of complexity when it comes to state laws.
Yeah, that can have to do with the court or the lawyers or the judge or whatnot, not being aware what state that the policy was actually delivered in.
And so, Stephen, that would actually be a good presentation by the carriers to come and present to us on, if they have any legal people in their firm that can come and kind of help us with that question.
They have floors of legal people.
Right.
At least a floor of them, guaranteed.
Yeah.
That word, guaranteed.
Yeah, that one definitely comes up. All right, so ex-Mennonite banker. I love that name. So
I don't know who that guy is.
Yeah. What was your question?
That's me. So my client asked, what does he have to worry about when to take a loan and when to pay it back to avoid the policy from becoming a MEC? And I'm like, wait, one of us certainly missed explaining how a policy loan works, because the policy is the asset. You're feeding premiums into it and you're building cash value in there. It has a death benefit. Dividends get applied to the policy. That's the asset, right? And that's the part that you got to worry about, the MEC limit. The policy loan, the easy way to think about it is that it works just like it's more like an external line of credit, just like a line of credit on a house would be, where you're just borrowing against the value of the asset. So it has no bearing on the MEC limit. And it kind of leads me into Kathleen's question next, as far as reason. Okay, what does she say? Can you discuss reasons for paying back policy loans as opposed to only paying annual interest on the loan? Is it for dividend growth? Thanks for explaining in first grade terms. It is not for dividend growth in the case of the companies we typically use, because we will specifically use non-direct recognition companies, meaning that the dividend rate and the dividends applied are not affected if there's a policy loan outstanding. And then the reasons for paying policy loans back versus not, that's going to depend on what you're using the policy loans for and how the money went to work and how it's paying you back. So if you used it to finance a car, all right, now turn around and make the same car payments back to yourself that you would have made to a bank or finance company, and that should be going back to policy loan repayments. Same thing with, say, rental income, if you used it to buy rental property, or interest payments if you lent the money out. But in some cases, like if you're doing your own real estate deal, it's a long flip, like it takes a whole year or whatever to get to the point of refinancing or selling. It's like, okay, your money is all out there, it's working, there's no cash flow coming back yet. That's when it would make sense to only pay the annual interest, or even skipping paying the annual interest if you really have to, because the annual interest is actually not a required payment. I certainly suggest it, because if you don't make the annual interest, it gets rolled into the loan balance for the next year. So it's effectively compounding against you as far as the loan balance goes. But that's how that kind of works out.
Yeah. And then Kathleen, as an example, if you're doing an investment with Kevin, so Kevin does notes, by the way. So what you can always do is, let's say that you can structure a payment where, let's say they're paying you cash with $1,000 per month. That's profit for you. You can take a certain percentage, goes back into the policy loan, certain percentage goes to you as profit. There's lots of different ways to structure that. But if you're having, like Linda said, if there's cash flow coming in from what you did, I would recommend taking a certain amount of that and going into the policy loan, because guess what? Now, this is the thing, though, that is very different. And I want everybody to understand this. So when you get a car loan and you make a payment, that money's gone. It's not liquid anymore. But if you're getting $1,000 per month and you don't need the cash flow right now, I would take every cent of that and put it into the policy loan, because that $1,000 is still liquid. In your mind, you might be saying, "Oh, I'm making a payment back on this loan. Oh, it's an expense." No. You're paying back the loan, but it's a revolving line of credit. It's still liquid. And that's a huge thing that a lot of people don't understand. Because if you don't need the money, why would you take it and put it in your savings account? Because a savings account or a policy loan payback is still a savings account essentially, but one is actually benefiting you, and that's paying the policy loan down because you're paying less interest. But once you start to see these kind of things in real life, it's pretty cool. But a couple different ways you could use that right there. And then, so Stephen did put this in there. So if you guys want to go get some recordings of one of our last 3-day events that we did called the Blueprint, just go to that link right there. They're really good recordings. They're phenomenal recordings. So definitely check those out. But yeah, we don't have our next 3-day planned as of yet, but check that out right there. I don't think he put in the link of all the other events we do, but you can go to chrisnoggle.com and you can register for our Wealth Wednesday webinar and a couple, I think the Monday one as well. Because those are on Zoom. But you can just go to Chris. I'll put it here in the chat box real quick. Let's go to chrisnoggle.com and you'll see those there on the events and I think it's events and tab. Yeah, so Spodnik, you're in Connecticut. Yeah, we write in all 53 states. So kind of funny, but it's all 50 states and also Puerto Rico. We can do Guam and we can do Costa Rica as well. I'm trying to think. Linus,
DC.
DC, yeah.
Yeah.
That's a very rare one. It's weird how I've only had out of, 2,000 people, I think I've had one in DC. One. Blew me away. And I'm like, oh, should I go get my license there? I didn't that way. But yeah, so we can do a lot of different areas. But yeah. Let's see here. Okay. Well, I think that's all the questions we got. So if we don't have any other questions, we might call it a bit early here today. But let's see here. Oh, this is another question we got today. It's kind of an interesting one. And this is a good thing that I don't think we talk about enough. It says, is figuring out how to best design our policy, is that done once we are approved for the whole life?
Maybe.
So maybe. So I think how did we answer this on that one? I think how we answered it is, so what we typically will do is we will design a policy for you ahead of time. Yeah, and you're going to see it. We're going to go through the numbers. You're going to see the forecast, all that kind of stuff, and we're going to tweak it. But it takes about anywhere from 5 to 8 weeks to go through underwriting in some cases. It can take a while. So while we can update the illustration and check numbers, oftentimes what we'll do is if you're like, hey, I want to go, but I'm not quite sure on the exact numbers yet, we'll get the application process started, but we can keep revising numbers. Get approved, we can keep revising the numbers until we get them dialed in, and then you only move forward when you're ready. So, but also the approval can affect the numbers. So that is the one kind of catch. If you get like a higher rating, so there's standard, and you get preferred, and then super preferred. If you get one of the preferred ones, that's a good thing. It's not going to have a negative impact on your policy. It just makes it a bit better, by the way. But we never assume those. We assume standard. But if you get a substandard rating, B, C, D, E, F, that can impact the policy and it can make it not as efficient. So sometimes once we get a substandard rating, then we got to sit down and go back through the numbers again and try to tweak them as much as possible. But that was kind of a good question. We don't talk about that. But Linus, you do that a lot on the application side.
We'll start with a preliminary illustration, we call it, because we have to show the underwriter about what we're shooting for, even if we don't know a health rating yet. And you don't want to be committing to something specific or putting money down on something specific yet. We want to get through underwriting just on a preliminary basis. So we'll be showing them what we're going for, but nothing more. And then once there's an approval, like Brian was saying, if depending on the health rating, we may come at it with a completely different approach as far as designing it around your premium amounts that you're working with and what you're trying to do with the policy. But other times there's no changes. And as long as you don't want to make any changes as far as how much you want to put in, we may be moving forward with exactly the preliminary design that was initially done. So there's always different pieces and different paths to take.
Yeah. Yep. And then is it D we can't, or is it E? Which one's you can no longer do infinite banking? What rating is it? I think it's F, isn't F?
Above table 5. So F5 still works. Anything above that does not.
Okay.
but it is also company specific. Right now, there's a company that only works for infinite banking up to table 2. So anything higher than that no longer works for infinite banking whatsoever, at least not within the first 20 years. But they are making some changes to where their ratings will be able to be higher for still an infinite banking design. However, it's interesting, between companies, ratings don't necessarily match. So the same health conditions that might get a table 5 at one company might get a table 1 or 2 at this company I'm talking about. So it can still work there. So it's interesting that they all have different underwriting guidelines for health stuff, criminal stuff, financial stuff that might get you rated. So they'll all land at different places. So those are things we specialize in knowing as well, to make sure we're taking you to the right place to be able to do what you want to do.
Yep. Let's see here. Spudnik's asking, what is the cost range to work with your program?
No, you don't pay us a dime.
Yeah. If anybody says, hey, to do infinite banking for you is going to cost you $1,000 or $5,000, run away.
Or join my group, which costs $120 a month. Join my coaching group first, and then we'll teach you infinite banking. Yeah, it's BS.
Yeah. Now, by the way, no, it's kind of funny. I did do that. So this is years ago, by the way. You didn't have the social media content you have today. Mm-hmm. You didn't have the way to learn it. So I had it's a coaching program. Part of it was infinite banking, but that was not the main thing, right? It was just one of the pieces that we did teach about and talk about. But nowadays I wouldn't do that because, I mean, the content's out there now. There's a different way to do it and to teach people. But yeah, that was a very interesting business model I had. It did very well. Yeah, it's kind of crazy. So this is kind of an off-topic thing here. So this is a program that taught it. And if I would teach it on a webinar to, let's say, 10 people, maybe one person would move forward with infinite banking. If they purchase the course, 80% would do infinite banking. 80%. Why is that? It's the knowledge. It's the knowledge. Because they had the knowledge all of a sudden, and they valued it a lot more. Mm-hmm. So, but once again, the marketing world has changed quite a bit.
Yeah. Going back to her question here, or I'm assuming her, M. Spodnik, the question as far as cost goes, when it comes to setting up a policy, it's going to work more like your own private banking system. So you get to decide how much you want to be depositing into your own banking system. Now, we can't necessarily call it deposits because it's still life insurance. So we tend to call them premium deposits. And so you get to decide how much you want to be putting into your system. And that's going to be directly correlated to how much it grows or how much is in it to be able to use to finance your next major purchase in your life, or to invest from, to go knock out debt that you have, that kind of thing. So I tend to look at premiums as less of a cost. Sure, I mean, there's still costs baked into it, but I tend to look at premiums as less of a cost and more of a deposit, which I just went over. But then when it comes to like the smallest type of premium that can work for infinite banking, typically we're going to say about 10 times your age monthly. So if you are, say you're 40, 10 times your age monthly, that's $400 a month. That's going to be about the minimum that works for infinite banking. Now, less is possible. It just might not be something that works for infinite banking. But yeah, that kind of gives you an idea of where the minimums are, but the maximums really are going to be mostly up to you. How much do you want to be putting into your own banking system?
Yep.
There's Dexter, Mr. Believably Amazing, and that's his other pet line. I started and learned as I earned.
Yep. All right, well, we've gotten through all the questions so far, so I think we're good to go. I don't see anything over here on the other channels. All right. Well, that's another Ask Me Anything in the books. With that, go ahead and go to chrisnoggle.com if you guys want to grab some of the other events that we have each week. And then, of course, there's a link up there above to grab a time with one of us to go through your situation and how infinite banking can work for you. So, what a question. So I got a question, Fouts.
What's your question?
I don't know. I'm not sure what the question is, but with that, we will see you guys next week.
No.
Thanks, everybody.